Welcome to the Dealmakers Podcast. The Dealmakers is a platform for leaders in the commercial real estate industry to share their personal stories, business insights, and industry secrets because we believe in spotlighting the real people behind the deals. This podcast is brought to you by Agora, a comprehensive real estate investment and management platform offering a wide range of services to enable real growth and provide the best real estate investment experience both for GPs and LPs. I'm Asaf Raz. Let's go.
And today I have with me the one and the only, after 3 reschedules. Finally, we're doing this. Denver Lobo, CFA. Today, well, he has vast experience. He's going to talk to you all about that. But he's today the managing principal of JT Capital based in Austin, Texas. Denver, please take it away. Tell our audience, a little bit about yourself and what you do at JT, and we'll take it from there.
Well, thanks so much for having me, Asaf. And, it's amazing to see the amount of education that you and your podcast has been providing everyday listeners to just learn more about the commercial real estate space. I hope I can do a little bit of the same for your listeners as well. I'm happy to share it with our 2,000 or so investors. I'm sure they'll get something great out of this. So for those of you who don't know me, my name is Denver Lobo. I'm one of the managing principals at JT Capital and oversee their capital markets and underwriting groups. JT Capital is a real estate private equity firm that invests in 200 plus unit multifamily properties in Texas and Florida primarily. And prior to JT Capital, I founded a fintech company named PayUp that was providing real estate contractors across the US access to capital. And prior to that, I spent about 10 years in investment banking at Credit Suisse, raising debt capital for companies and countries in Latin America, Asia, and EMEA as well. And as you mentioned, prior to Credit Suisse, I got my undergraduate degree in finance and economics at Notre Dame and my CFA shortly thereafter.
Thank you so much for that, Denver. So right away it pops up, and I love these kind of special stories. How do you go from, was actually MasterCard, Morgan Stanley, Credit Suisse to your own fintech company and doing that kind of switch between what was more like fintech, finance with the tech kind of merged into it to actually doing like managing being a managing principal at JT Capital and focusing on real estate and really kind of deep diving into that vertical?
Yeah, sure. So if you think about the global economy, and if everyone here can picture a number as a percentage in their mind about how much the world's transactions are still transacted in cash, if everyone can take 2 seconds to think about that number, think about your own experience where you go to H-E-B or the gas station, you're probably spending 20 to 25% in cash versus all the rest on your credit card and digital transactions. The world's transactions, 80% today are still done in cash. If you think about that, companies like Visa, MasterCard aren't competing against themselves, they're competing against cash. So I love those companies as, a trend that not only in the US, we see more of digital transactions, but especially in emerging countries as well, that safety, that education about transacting digitally rather than in cash. And so that's kind of where I got my start at MasterCard. Investment banking was an incredible experience to learn financial modeling, to learn corporate structure, to learn how to interact with a lot of different groups, and ultimately provide your clients with investment opportunities that they were excited about and that impacted their portfolio in a positive way. So we were working with pension funds, asset managers, endowments, family offices, RIA, broker-dealers to provide them with investment opportunities in Latin America, Asia, EMEA, like Russia, Turkey, South Africa, that impacted their portfolio in a positive way. And so they were always looking for debt instruments or yield instruments that they could take back to their own investment clients and ultimately create a portfolio around it. So I did that for about 10 years. And all throughout that journey, I started to fall more and more in love with real estate. And the first book I read is the quintessential real estate book. It's Rich Dad, Poor Dad. And started to love the idea of real estate as a passive investment to grow wealth. And by the time I was ending that investment banking journey, I found that real estate was a large part of my overall portfolio. And so I tried to figure out what is the next step to kind of get me closer there. And instead of jumping straight from investment banking and going straight to real estate private equity, decided to take a little bit of a roundabout, untraditional path and started my own fintech company. However, it was focused on real estate. So I learned about how property management, very large property managers service the largest commercial real estate holders in the US, worked with almost 300 contractors and providing them access to working capital to get them to do more jobs, faster jobs, larger jobs. Extremely exciting to hear, how we were able to overcome their pain points to get them to the other side to allow them to grow their business. And ultimately, where I wanted to land was real estate private equity, because that's where you can really change your investors' lives and you can change the lives of the residents that are living there. And so that was kind of my journey, going from buying small single family duplexes all the way to buying 200 unit multifamily units.
Wow. What the change and the shifts and also the timeframes between those changes that you've had are really inspiring. I mean, like deciding to go into that, you've been at JD Capital for 11 months now, but you've been into real estate like forever, but just from different angles. So having those different perspectives, I feel like is really unique, comparing to other real estate investment companies. So that's very interesting, and I'm gonna want to kind of focus on those differences. But before we do that, let's do something a little bit more fun. So what is that one story? And everybody has that one story, especially in real estate, because it's so tangible. What is that one story that you'll never forget about real estate that made you think, okay, like this is it. Like this is the thing that I need to do, right? Could be an asset that you saw, could be an investment that went right or wrong, could be an interaction with a broker that actually made you think, okay, we need to do this, could be a conversation with an investor, but that one thing that you were like, okay, this is my thing. This is what I need to do.
I will answer that with a clear answer, and it's called the BRRRR method. So I'm sure you've had folks on here talking about that method. I encourage every single person on this podcast to understand that method and how it works. It's buy, rehab, rent, refinance, and repeat. And the power of this BRRRR method in real estate, in a nutshell, because we won't go straight deep dive into this, is you buy a property for zero money down. Imagine you owning a property worth $200K for zero money down and earning rent payment per month that covers the mortgage, the interest, the taxes, insurance, and everything that you have to pay for. That means that you're getting pretty much unlimited upside from these investments. And over time in the US, there's never been a 20-year period in which real estate prices have been down. So imagine you using no money down to own these houses, and now all the appreciation of these houses go to your equity and building your net worth. I think that's an incredibly powerful strategy and something that was my aha moment to say, you know what, I want to do this. I was able to do it at a small scale, but the only way you can go to the big scale is really partnering with people and, understanding who the players are on the bigger side.
That makes a lot of sense. And we're going to add some links in the bio and some information also about you if anybody wants to consult on how to do that first step. I'm going to definitely reach out to do that with you as well. Been looking around to do my first actual step, like in buying my first asset here in the US. I do have some in Israel, so it's going to be interesting to have one here. So we're definitely going to talk about that, and our listeners, investors, brokers are going to have access to that as well, Denver. So hopefully we'll have some good things to share with them there. Let's talk a bit about the market right now, and I think that's like a focus on specifically your expertise when we're talking about underwriting. I mean, underwriting currently is I feel like scrutinized by investment firms just because they really want to understand the economics behind an asset before actually deploying capital into it. Interest rates are high, insurance rates are up, construction rates are up. Like everything is getting more and more expensive, I feel like. And then on the flip side, people are saying like, okay, no one's going to buy asset, deal volume is down, blah, blah, blah. The whole thing that we all know about. We talk about this every episode. But then people like you, JD Capital and other companies continue to invest in deals all the time, maybe in a lower volume, right? And they have their existing assets. So what are some things that you're seeing in terms of trends in changing that kind of investment environment for real estate, both this year, but also going into 2025 and like kind of into the future of real estate? What are some emerging trends that you're seeing on your end when it comes to your investment strategy, and the assets that you manage today?
Sure. So the first one I'll talk about is demand and supply. So you start, when we look at assets, we look top down, and then once we find the right asset, we look bottom up. So demand and supply, I'll give your audience a little bit of the scale of which things have changed since 2021. So the drop in property sales has been dramatic. It's never been seen over the last 15 years. So to put numbers there were about $230 billion of sales in 21. There were about $200 billion of sales in 22. And as of November 2023, there were $60 billion of sales. So essentially a 70% drop year over year compared to 2021, 2022 in sales. So for those investment managers that you're talking about doing diligence very in a scrutinizing way, I think that's a great idea, because you want to get into the right opportunities. And you hit the nail on the head in saying expenses have been rising in this asset class. And so insurance has gone up, taxes has gone up, and the one everyone knows about is your mortgage has definitely gone up. However, we see all of those expenses and costs going up, and the shock to how fast they went up kind of in the past. Because if you think about it, mortgages are coming down now. If you thought that if you saw the 10-year rate for 3 years was over 4%, right now, last Friday, it just dropped under 4%, which is extremely exciting for buyers and sellers, because sellers say, we had our targets to sell this property at a certain price, but no one was meeting us anywhere near it. Now the buyers are kind of stepping up to the plate and offering more for investments because interest rates are coming down so that they can finance at a better rate. So the first one is the drop in demand and supply. We look at it glass half full and we say, hey, there's pent up demand and supply upcoming. And if you think about who owns multifamily today, it's a large part in the baby boomer kind of generation that owns a lot of these assets. And so when you think about them transitioning and giving their assets to either their heirs or selling their assets and just enjoying themselves on the beach, you want to be either on the other side of that transaction, buying that asset, or in the middle of the transaction or somewhere in that transaction, right? You want to be there, and there's going to be one of the largest wealth transfers like in the US has ever seen when the baby boomer is going to shift all of those assets over. We want to be there. We want to be catching all of those assets. We want to be buying as much as we possibly can. The other trend has been there are a lot of folks who bought properties in 21 and 22 with floating rate debt. Now, for most folks listening, they'll say, well, I buy my home or house or rental property with 30-year fixed rates. Why did they do floating rate debt? Well, it was cheaper to set up. You pay closing costs. Closing costs were cheaper. And ultimately, your floating rate was 0.51%. Why wouldn't you want to hold that? Now, fast forward, a couple of years, and that floating rate debt was 9%. So to jump from the 3% range to 9%, that was a 300% increase. No one saw that. So what a lot of these owners have to do is they have to figure out how to pay for that mortgage payment. So they say, what are my options today? Can I go back to the bank and refinance my debt? Well, the problem with banks today are that if you heard about the scares in March 2023 about SVB, First Community Bank, there's a public perception of regional banks being a little bit under the weather and being invested in a lot of the office assets that have kind of gotten hurt in recent years due to the COVID kind of story and more people working from home. banks are reluctant to refinance your debt. Second thing is they could go back to their original investors and say, guys, we got it wrong. Can you please give us more money? And how would you feel as an investor being like, oh, I got it wrong. Give me more money on this asset that's not doing well. You don't feel great. And then the last one is they'd go to a very large private equity firm. Think BlackRock, Oaktree, the largest of the large. And the problem there is that they have funds that are $2 to $3 billion in size. So for them to do a single check of $3 to $7 million, it would be so operationally inefficient for them that they would never do that. So they're looking to write checks for $20, $25 million, which our holders, which our multifamily owners just don't need. So that was our genesis and our thesis for the idea of starting a $75 million private credit fund that supplies that part of the market. So we're looking for Class A properties. This is 2020 plus properties that are stabilized. So 90% occupancy, really good operator. And we're looking for them to be the borrower of our money. Now you think of credit cards and you think, there's some folks that really, really need the credit. And there's some folks that are literally using a credit card for points, right? We want to be on that side of lending to a borrower that just needs it to get to the finish line, which is either a sale or a refinance point and give our money back. So those are two really big themes in the market today. And then the last theme I'll touch upon is the amount of loans that are maturing, meaning that all these multifamily owners and sponsors have to take some kind of action. They can refinance for sure. They can also sell, but they have to take some action because their loan's maturing. There is $620 billion of CMBS expected to mature in 10 years, and almost 20% of that is 2024 and at the back end of 2024. And so if you've heard the saying, if you owe the bank $100, you have a problem. If you owe the bank $100 million, the bank has a problem. And so again, it goes back to the saying that these banks are a little bit stressed. They don't want to be lending. That's where we come in. We lend $3 to $7 million to multifamily owners that are really well capitalized, that don't necessarily need the money, but they're using it as a business decision to get to that sale or refinance point.
Yeah, and you're not the first one that I'm hearing this from. The decision to create, either like a private credit line for those type of syndicators that are either distressed just due to the current situation of the market, or they're just looking to expand a little bit more, and they need, cash is king right now. They need the money in order to deploy that into new assets or existing assets. And I've seen this happen many times. In the past, I feel like 2 years. And this correlation between, private credit or lenders, private lenders that are opening their own like debt funds or debt vehicles for people to invest in, I feel like it's pretty unique. And I'm comparing this to the only era where we've seen some sort of change like that in the market, which was 2008. And if you've been here in 2008, I was pretty young at 2008. But if I remember one thing from 2008 is that lenders were the major banks usually, and some of the regional banks, and they did not want to work with the owners or with the investors and on working on solving the debt crisis back then, right? And that's what got the banks to almost crash. So I feel like what's changing right now is two things. A, the banks want to work more with the GPs, with the investment managers, and we're seeing people like you, like what you're doing with JT. We're actually creating different solutions for refinancing to help them prolong their life and not to distress sale their asset, call more capital from investors. And that is what I think makes a lot of the difference. That's why we're seeing, like, for a long time, people have been saying, yeah, real estate is going to crash. We're going to see rates go up. We're going to see valuations go down. But none of that really happened. Yes, there was a slowdown with deal volume because it makes sense because it's harder to do deals right now. But we didn't see that crazy crash people are talking about. I was waiting for it in 23, nothing happened. I was waiting for it in 24, nothing happened. And I feel like these are the type of moves that actually make a difference in the market. And from there, what I'm trying to understand from you, and I think that would be also very beneficial as a company that holds some sort of a debt vehicle for syndicators, for GPs. What do you think are some of the greatest growth opportunities right now for these GPs? What are some moves that they need to make today, either if they had floating rates or fixed rates, short loans, long-term loans, if they're doing flips or doing long-term holds, investments, cash flow, whatever they're doing, right? What are some of the opportunities that you're seeing right now that they need to kind of capture before it's too late?
Yeah. So the first thing I'll talk about is just touching a little bit about private credit. So you'd mentioned, private credit, just for the benefit of everyone listening to who don't understand private credit. It's very simply, it refers to any lending source that is not from a public entity like a bank. So if I lend to Asaf, it's considered private credit. Now, we wouldn't necessarily record that anywhere, but that's what private credit is. Very lending, very borrower specific. There's a lot of customization to it, and the biggest advantage is speed. With a public entity, you have to go through maybe 2-3 months of back and forth with the lender. Then they have to go to committee, and there's 7,000 steps to get it to the finish line. With us, takes about 3 to 4 weeks. You get to the finish line and you get your capital. You're able to use it much faster. So the ability to close fast is much faster in the private credit space. Now, what we always have to look at is, sure, for the person we're giving money to, everyone loves money. The question is, how do we get that money back? Are we giving it to the right borrower? Are we giving it to the right asset? Those are always questions that we're asking. And then on the other side of the equation is our investors into private credit too. There's high net worth investors, there's RIA broker dealers, there's family offices, there's institutions that all like this kind of risk because the risk reward is incredible compared to stocks or bonds. So I'll explain that a little bit, because we're able to get anywhere from 16 to 17% IRR, meaning 16 to 17% return on your capital every year, for taking the risk of selling the entire building and probably recouping our 16 to 17% anyway. So the risk reward of having this strategy right now is incredible. Why didn't it exist before? Because interest rates were too low for this product to exist 5 years anyway. So that's why it just didn't exist. Why would we not do sort of the senior lending, which is more bank lending, is just because you need so much capital to kind of, be effective there. You just need billions of dollars to be the first mortgage lien on these properties. So we feel like that preferred equity or mezzanine financing in the private credit space is the most bang for buck at the moment. So your second question was, what do GPs do today to sort of get over this hump? And so what I would say is, and this probably doesn't bode well for us, but I'm saying GPs should not sell, and they should just ride their assets as long as they possibly can. Everyone sells for different reasons, but for us, we're long-term holders. We love the markets that we're in. It's also market specific. You want to be encouraged by new jobs moving there, high quality jobs, high quality education that's moving there. And so we are looking to buy as much as we possibly can in this market. And the reason is those shocks to expenses that drove expenses up, we feel like our thesis is that it's in the past. So now when we project the future in our underwriting, we have a little bit of a better sense, and we can be even more conservative with our underwriting because we actually increase costs higher than what we did in the past. And we, increase rents actually lower than what we did in the past, just so that we have that buffer. So I think GPs should focus on the value add strategy. If they had a value add strategy going into buying a property, they should finish the renovations. They should, add those amenities that renters are looking for. They should overall improve the community, At our buildings, we have yoga folks come in and teach classes. We have a masseuse come into the gym, and if you want, a massage and stuff like that, it adds to the overall vibe of the community. And typically, when we sell our assets, the tenants are like, "Where did all of these amenities go?" So that's kind of the impact you want to have on your portfolio, so that you're actually enacting change rather than just looking at it as an investment.
I like that a lot. That's a really, I feel like, unique to what you guys are doing. So I really like that. So in order to keep my promise to the audience, to keep the episodes short, I think, Denver, we have so much to talk about. And in a second there, after we finish this episode, we'll talk about the opportunities that we have to kind of continue this conversation. But I really like this. This was really insightful and kind of, for me, created more of like a positive outlook as to what's going to happen now and what's going on and what we should do as real estate investors. As always, the last part of the episode is what I call the shameless plug. And that is, Denver, where I invite you to shamelessly plug in what you guys are doing right now, what you're doing right now. What are you looking for? We've had a good amount of connections that happen through the podcast. So investors that liked a specific GP, they decided to invest in them. Funds that were open, and people kind of talked about this in the episode, and then they were able to expose what they're doing right now. So please, as shamelessly as you can, what are you doing right now? What are you looking for? Let's try to get a good connection here.
No, well, I appreciate that, Asaf. So we are looking for investors for 3 specific investment opportunities. So the first one is one that I touched upon, which was private credit. We have a fund that does that. There's 2 share classes in that fund. One offers a 10% preferred return plus equity upside. One offers a 12% return. Those returns are significantly higher than what you can find for similar strategies in the space. The second one is land entitlement. So if anyone, likes to buy raw land and entitle the land and then sell it to a developer, we're always doing that, not only on the private equity side, but also the personal side. So we're always open to other investors saying, teach me more about this investment. I'm open to looking at it. And the third one is multifamily. We're always looking to buy new multifamily, and we're always looking to get more high net worth folks come in and partner up together to really buy these assets and to really build the business plan too. JT Capital is unique in the sense that it is typically the lead or sole GP on all of these deals. So there's not a lot of people at the table. It's only us. So you're only talking to us. We're the ultimate decision makers. So y'all can kind of feel comfortable about asking us as many questions about the business plan, about the financing. We're always open with our investors. And we have a company data room, and we have a data room per project. So you can go in, you can dive in through the financials and really take a look for yourselves as well.
Awesome. And we'll leave all the information. Everything's going to be on the bio. So it's going to be at reach if anybody's looking to do that and invest with Denver. Everything's going to be there. So thank you, Denver, so much for joining me for another episode and sharing your valuable insights and experience with us today. It was very enlightening to hear your perspective about the real estate industry and private credit and your personal journey within it. To our listeners, thank you for tuning in to another episode of the Dealmakers Podcast. If you enjoyed this podcast, be sure to subscribe so you never miss out the latest conversations with industry leaders. If you have any suggestions for future guests or topics, or if you'd like to be a guest yourself, please reach out to us via the Agora website or our social media channel. Stay tuned for more exciting episodes as we continue to explore the stories behind the deals and the people making them happen. Denver, thank you again for joining us today.
Thank you for having me, Asaf.